Hello world, welcome to Farm the Market. On the Stock Trading Journal series, I share with you some of my trades. I do not claim to have the epic strategy that beats the market every time. I just hope it's a good exercise for me where I get to analyze some of my trades deeply by explaining them to you. And hopefully for you, by looking step by step at examples of real trades, you might find interesting some of the techniques or adjustments I use on my trades. And this might help you in your journey to develop your own trading skills. This time we will take a look into a trade on VXX. Let's get started. First of all, I would like to do a quick summary about VXX. VXX is an exchange-traded node managed by Barclays that provides exposure to the S&P 500 VIX short-term futures index total return. This index is a constant 1-month rolling long position in the first and second month VIX futures contract. This basically means that it tracks the short-term volatility on the VIX term structure. Perhaps the most important concept to grasp about VXX is that it is a decaying asset. Think about it. It seeks to replicate a long volatility position. Therefore, just like being long an option, you have time against you. That's why, if you look at a long-term chart for the VXX, it seems that it always tends to go down. It's not magic, it's just part of its nature given the index it tracks, and therefore, every relevant market participant is aware of this fact and it's priced in. In other words, if you are long this instrument, there is always a headwind. Very important. This doesn't mean you can just short VXX and make a lot of money. As you can see in the chart, when volatility spikes, the moves can be brutal if you are short. There's no free lunch in the market, and even less so in the volatility space. Please note this is just a simplified summary. For more details, review the corresponding fact sheets. Having said that, VXX can be a useful instrument to have in your toolbox when you have a certain expectation of volatility in the short term. On Wednesday, February 9th, the market was behaving oddly from my point of view. As we all know, the key factor driving the markets right now is inflation and the implications this will have on the Fed monetary policy. That Wednesday, one day before the highly anticipated CPI number, the market was rallying. Too much enthusiasm in my opinion given the circumstances. Since the market was already pricing in a market-friendly CPI number, I decided it was a good opportunity to take a contrarian position. With that in mind, I decided to buy a VXX call spread. If the market liked the CPI number, volatility could drop, but not by much. On the other hand, if the market didn't like the CPI number, volatility could spike. Therefore, it looked like a good trade-off to be in a short-term long volatility position. With that in mind, on Wednesday I bought 20 contracts of the 2023 call spread with expiry date on February 18th. Why use a spread and choose those levels in particular? First of all, I rarely open just a long position in options. I find it more efficient to work with spreads. You don't really need exposure to quote-unquote infinity, and it's a great way to minimize the entry cost and time decay. The starting level of 20 is a bit arbitrary. Since I was looking for a spike, it seemed to me going a bit out of the money to reduce the cost of the long call made sense. Therefore, I chose that level. Regarding the short call at 23, selling at that level balanced the spread nicely since the premium received got me to close to an 8-to-1 relationship between the premium paid and the width of the spread. And regarding the expiry date, even though I was aiming for a short-term trade, the February 11 expiry was just too close, so I chose February 18 instead. In terms of risk-reward, for options strategies, my starting point is always to compare the possible extreme scenarios at maturity. Options don't have a linear behavior, so it's a good idea to analyze your extreme scenarios first to assess the maximum risk and then you can quote-unquote play within those limits. Since I will belong the spread, my worst case scenario was to lose the whole premium, 32 cents. On the other hand, since the spread was $3 wide, The base case scenario and maturity was $3 gain. I was risking 32 cents to make $2.68. That's where the 8-to-1 ratio that I mentioned earlier came from. It's important to note that this kind of trade is seldom held to maturity. You must manage it along the way. If the plan doesn't work quickly, the spread would be sold and some of the premium paid will be recovered. You do not let it go to zero. On February 10th, the market initially reacts well to the CPI number. The S&P 500 goes up and the VXX is relatively stable. Note, the VXX doesn't go below Wednesday close at any point during the morning. There's no reason to act, so I just give the position time to breathe. As the session advances, the S&P 500 drops, volatility increases, and the position goes into positive territory. As the VXX was moving up, the price went above 20, beyond the strike of the long call. However, that wasn't really what I was paying attention to. What I was really paying close attention to was what fraction of the position could get me to break-even territory. Once it was 50%, I decided to sell. I got lucky, and the price went a bit further and even a small profit was achieved. But the idea was to ensure the break-even point. I sold half the position at an average price of 88 cents per contract. Now, the trade will be profitable no matter what happens to BXX in the following days. February 11 is an ugly red day for the market. The BXX goes beyond 23, the upper limit of the spread. Towards the close, BXX comes back a little from the highs of the day, but not by much, and since I have no risk on the position, I decide to give it another day. On February 14, BXX goes up again, getting close to 25. However, as the session advances, the price declines. The price of the spread is right now around $2, almost 2/3 of its maximum value, so I decide to take profit and close the position. The price slides a little bit more and I actually close the position at 1.87. In general, a good trade. Looking back at the trade, I guess the first question would be why was I in such a hurry to lock in the break-even point? In hindsight, the profit would have been way better if I had just waited. The answer is by analyzing my history. Historically, on this type of positions, I tend to let trades that were winners at one point turn back into losers. Considering that, whenever I have an opportunity to secure the break-even point, I tend to take it right away. After that, it's much easier to manage the position. In other words, I'm working to be less greedy and improve my batting average on these kind of trades. Another thing I noticed while reviewing this trade is that as soon as I close half the position, I should have placed a limit order to sell the other half at around 70% of the maximum value. In other words, around $2.1 per contract. That's usually something I do for this type of trades once it is in positive territory. Looking at the intraday activity today, it would have worked perfectly to achieve a greater profit. So, what happened? Well, it might sound silly, but after thinking about it, my conclusion is that since I don't have many open positions at the moment in my portfolio, I've been managing them manually to feel quote-unquote more active. That's obviously a mistake. The process must be more mechanical. Besides, having the limit order in place doesn't mean I can still monitor the position closely. Something to consider for the next trade. I hope you found this video interesting. Please remember to like and subscribe. Thanks for your time.